We got CPI inflation data this morning, came up a little more than last month on a year over year basis. However, we're still higher than where the Federal Reserve would want. Now, what's going to happen with the economy moving forward? We have a big transition that's going to happen on January 20th. What happens after Trump takes office? More specifically, given the economy, where things are moving, what happens with TLT stock? And I also want to talk about TMF stock. TMF stock and TLT stock are relatively the same unless you like a lot of juice when you do your squeezing. TMF stock will move more so, but we're not at that area with the economy when the Federal Reserve is really going to make a protracted move lower with interest rates, which would drive TLT stock and therefore TMF stock much higher. So I wanted to break down what's going on with the economy overall, how expectations for the new Trump administration with the extension of the Trump tax credits, tariffs, and what the Federal Reserve would do and how that would affect TLT stock and TMF stock. Let's jump in. We'll look at the data on CPI data released this morning and moving forward, looking at the money supply, which is really one of the things you want to take a look at. I think there's going to be some bumpy roads ahead for a small amount of period of time, but then the Federal Reserve will probably get busy and start lowering interest rates. Let's jump in. We'll look at some charts. First off, here's a look at the core month-over-month change on CPI. And as you can see, last month was kind of a bigger monthly move higher. This month, not so much. The big change was, or a big chunk of this, about 30%, according to what I'm looking at and reading, is housing, rentals, things like this. They moved upward, and that really was a big chunk of this. And I do want to talk about housing as an issue, but I'm going to do another video coming out next week on housing specifically and kind of break everything down. Regardless, CPI core rate outside of housing on its way downward. Here is a look at the year over year change. The previous chart was month over month change. This shows a slightly elevated core rate. Now, core takes out, of course, food and energy, which from a month to month or a quarter to quarter can be quite volatile. So they take those out and just take a look at core prices. But it is, again, housing that's really kind of a big factor in what's going on. And in fact, the biggest portion of the spike up, so it happened right around, I think we pretty much got the low in early 2021, like February. And then all of a sudden, inflation just spiked up really high, and you could see that. We had all this money being printed from the Federal Reserve, from the stimulus checks. Simultaneously, you had a breakdown in the supply chain, and so companies got ahead of that and started raising prices. And guess what they never did after that? Lowering prices. You can see corporate profits are at record highs, have been going record highs quarter after quarter after quarter, and all the little hamsters on the wheel need to just run. Here is the money supply. And this is one of the things I really kind of been looking at a lot because we're seeing a big spike in the money supply, the rate of growth. It's a little difficult to see in this, and my next chart's going to really kind of point this out. If you kind of take a line and you look at that, we're on a trend line basis given what the Federal Reserve pumped, then took back out. But here's the thing that's really important to understand about the money supply is that we're a fractional banking system. And as you can see, the rate of growth is getting closer and closer to the median price. Now, I do not expect the rate of growth, the year-over-year change in the money supply. This is the exact same chart you just saw. It's just the year-over-year growth rate for the money supply. I don't expect it to hit median and then just go flatline. What's going on here? This is both cause and effect. Inflation becomes effect. The price of money is growing rapidly. You're seeing this rate of change moving higher and higher because the price of money, in order to borrow money, it has a cost. Interest rates, it's too low. And because of that, we're seeing an accelerated growth rate in the M2 money supply. This will manifest itself in inflation. You're going to see, and why, I mean, when you break this down, when you really start looking at this year over year change in the M2 money supply, you can see what's happening in the, say, bond markets with TLT stock and TMF stock as your target. More likely than not, the Federal Reserve is probably not in a position to lower interest rates at a rapid pace because the economy is doing well. Money is being borrowed at a high clip comparatively. Price is too low. This to me is a red flag all the way across the board, but it's a short-term red flag because we have outlying factors that are going to start happening apparently either January 20th or 21st, whenever business gets started with that. Trump tariffs. Trump tariffs, of course, are going to literally remove money from the money supply. It's a tax, plain and simple. And if he actually goes through with his tariffs, this is a big sigh of relief with regard to what the Federal Reserve is looking at, because that tax will take money out of the system to pay for Trump tax cuts, which would happen in March. He'll extend that. So the deficit is going to be funded by all the little hamsters on the hamster wheels. All right. Given that, when you remove that money out of the money supply, the Federal Reserve has less of an issue because that's less money being spent on goods and services, which would drive inflation higher. But at the same time, there's something else going on. Higher interest rates is another kind of tax on consumers. Consumer borrowing for car loans, mortgages, things like this, credit cards. One of the biggest things right there. If the Federal Reserve lowers interest rates, that alleviates some of the issues for consumers on what they're spending on interest. So on the one hand, interest rates could go down lower, but the cost of the goods is going higher. It'll be an interesting sort of balancing act. I don't necessarily see any sort of economic tsunami where there's a complete just blowout of the economy per se. I see this kind of playing out slowly in a moderate pace of rebalancing where money's flowing because of the Trump's tax cut, then the Trump tariffs, then the eventuality of lower interest rates. Incomes are finite. Consumers only earn so much in an hour, day, week, month, annual. That's finite. So they can only allocate expenditures in a certain way. If you raise the prices of goods from Canada, Mexico, China, which is a big chunk of everything we consume, but you lower the cost of borrowing to buy those, it sort of starts to balance its way out. Moving forward, this is such an important chart for me. Now I'm using core PCE here. The Federal Reserve looks at the PCE inflation deflator more so than CPI. CPI comes out about 2 weeks prior to the PCE number. The PCE, the Fed believes, is more of a sort of true number. They're really about the same, but they're not 100% the same. They sort of track each other. What I did with this chart, I inverted the inflation rate to show that as the economy's expanding because of more and more money going into the money supply, price pressures move up as well. You can see this correlation is very strong. This is actually one of the strongest correlations of all the charts I look at. So as we see the money supply continually moving higher and higher, you'll see price pressures continually moving up and up and up until prices themselves jump higher because of the tariffs. then all of a sudden consumption is going to drop. That could also halt new business developments from companies. They're not going to be taking on more and more loans to expand their enterprises because consumers are spending less and less. This will alleviate pressure on inflation, which would allow the Federal Reserve to move to a more neutral and maybe even accommodative stance. This is going to take time. 3, 4, 6, 9, 12 months. Still, TLT stock, TMF stock, if you're a long-term holder looking for a big price number, this could be a solid opportunity. This is the US 10-year Treasury. Now, TLT stock and TMF stock trade on the 20 plus for interest rates, Treasuries. But I always look at the 10-year. It is a really good gauge between the two and the long-term 20 or 30. And this was the response as of the time of this video. Interest rates, of course, dropped, then went right back up. As a matter of fact, I think they might go positive for the day, which would be a lot of head scratching, but there's inflation there. But look what's about to happen in the future. Here is TLT stock, the US 10-year Treasury yield over a longer period of time. Now, back in October 2023, we saw that big spike up higher. You can see the 10-year crossing over the 5% level. I don't think we get above 5% again on this particular economic cycle, but we may start pushing for 4.25, 4.5, 4.75 range, not much more. Trump tariffs, if they actually hit in January, the market will sort of and say, oh, wow, that was real. Okay, how will that affect things? He's not exactly a man of his word, but this one he seems really serious about. We'll see. Mortgage rates. This is something that's really kind of crucial with what's going on with inflation. Again, the big jump, 30% of what we saw in today's number for the CPI inflation was housing. As mortgage rates remain elevated, this will affect the overall housing sector of inflation. But should this move much lower, mortgage rates, that would mean a lot of people are really going to start pushing into housing again. The good news, we get all our lumber from, not all our lumber, but a big chunk of our lumber, which is housing, and then your tiling and all that stuff comes from China, but the lumber comes from Canada. All of a sudden, there's going to be a big tariff on all that stuff. So selling a new home is going to be a lot more expensive. So even though the mortgage rate may fall because of interest rates moving much lower, when you look at the cost of building a house moving much higher, that's going to be a transitional balancing that's going to drive prices higher despite the fact mortgages might be sliding lower. We'll see how that plays out. We'll also see how that affects what's going on with the individuals who actually build the houses. Remember what happened in Florida with DeSantis when he targeted all the individuals building the houses in Florida. They all left. Remember that? Now we got one guy looking at the whole country. Here is TLT stock, the daily chart. I think we've seen the lows. I think they're in. I'm holding for 105, 102 half, 105, 107 half, 110. Can we get up to 115? Probably, but that's a long-term move. And right now, there's not any economic data that suggests we will get there at a rapid pace. Let's see what happens in January. But I still believe firmly that with TLT stock, the low is in mostly. Sure, TLT stock might slide a little bit lower, Maybe we see 92.5 to 90. I don't think we go sub 90, but eventually we will go higher. If you like a lot of juice in your squeeze, here's a look at TLT stock versus TMF stock. TMF stock, when it does move relative to interest rates and TLT stock, it moves more so. So for those who are looking for a bigger bang for your buck, holding a position that's in kind to TLT stock, TMF may be something you want to consider. My thinking is eventually on a percentage basis, which you can see, TMF stock during the same period of time is down like 80%. When there's a turnaround, you'll see a much bigger move higher in TMF stock versus what you would see in TLT stock. Again, if you like a lot of juice in your squeeze, this is the one to really kind of take off. I believe, for myself, for my position on TLT stock, that we've seen mostly the lows. There's no economic data that could really push the Federal Reserve to all of a sudden start pushing interest rates much higher with regard to inflation and what could possibly happen with the economy. It's sort of a balancing act between Trump tax cuts being extended in March, but having to deal with Trump tariffs in January. The Federal Reserve, more likely than not, will not see a reason or rationale to push interest rates higher, which would mean both TLT stock and TMF stock are about as low as they're going to be in this economic cycle. Then it's a transition into moving back upward, but at what pace, given what economic data? We get a whole new scenario come January. We'll see how that plays out. But these are your 3 bullet points. If you're trading TLT stock and TMF stock. Trump tax cuts, that's March. Trump tariffs, I think January 21st. Consumer interest rates. If that Trump tariff comes in, that will remove money out of the M2 money supply, because that is a straight tax going to the government to pay for the Trump tax cuts, which are tax cuts to corporations and the super wealthy. So the hamster's on the wheel, got to start running faster and faster. But this would allow the Federal Reserve to lower interest rates modestly at a slow pace, but a continual pace. The other thing to keep in mind is if this economy starts to run out of steam, what you would potentially earn in a return on investing in stocks could start to go sub a relative move in interest rates, and therefore all of a sudden bond yields would look quite juicy. If the stock market does turn around and starts to sell off because there is a slowdown in revenue growth rates, margins start to get thinner and thinner with corporate profits, your return on US Treasuries would start to look a lot more juicy. So you'd see TLT stock moving in and up much faster. There could be a big jump, but we're looking at 3, 4, 6, 9 months out. Once we see the effects of all these things playing out. My take remains the same. TLT stock, the one I'm holding and will hold for some period of time, I believe is about as low as it's going to be in this economic cycle. From here, it's a matter of eventually going up, given new economic parameters. When? We'll see what those economic parameters are. Make sure to hit that like and follow button. My Substack newsletter down below. I'll write this up and get that out there. Hit that like and follow button. We'll see you in the next video.